Stock option expensing. Stock option expensing is a method of accounting for the value of share options distributed as incentive to employees within the profit and loss reporting of a listed business. On the income statement, balance sheet, and cash flow statement, it should say that the loss from the expense is accounted for by noting the difference between market price, if one exists, of the shares and the cash received. The expense price for including those shares through the option. Opponents of conducting options as an expense say that the real loss due to the difference between the exercise price and the market price of the share is already stated on the cash flow statement. They would also point out that a separate loss in earning per share due to the existence of more shares outstanding is also recorded on the balance sheet by noting the dilution of shares outstanding. Simply accounting for this on the income statement is believed to be redundant. Currently, the future appreciation of all shares included are not accounted for on the income statement, but can be noted upon examination of the balance sheet and cash flow statement. The two methods to calculate the expense associated with stock options are the intrinsic value method and the fair value method. Only the fair value method is currently USGAAP. The intrinsic value method associated with Accounting Principles Board Option 25 counts the intrinsic value as the difference between the market value or the stock and the expenses price of the option at the date the option is issued, the grant date. Since companies generally issue stock options with exercise price which are equal to market price, the expenses under this method is generally zero. In 2002, another method was suggested, expensing the option as the difference between market price and the strike price when the option was exercised, and not expensing options which are not exercised, and reflecting the unexercised option as a liability on the balance sheet. This method which differs the expense also was required by companies. FASB has moved against option 25, which left it open to businesses to monetize option accounting to their intrinsic value rather than their fair value. Preference for fair value appears to be motivated by its voluntary adoption by several major listed businesses and the need for a common standard of accounting.